Good evening, everyone. Thanks for coming out for our final tax technical training of 2017. Appreciate everyone braving the cold conditions, the traffic, and everything else to get out here and be able to sit through the final about 3 hours worth of presentation on advanced issues. Really what the objective for us here tonight is to go through and make sure that we're covering a few of the areas that you're going to see beyond the basic certification. What we're looking at are some areas that we'll see most commonly found within VITA, which kind of advances you from a basic certification to that advanced level. Now, there will be a couple areas that we talk about that will have some complexities to them. These areas, while they're in the advanced topic, may be straightforward. There may be some issues that we still have that could be a little bit tricky to walk through. So the important thing to remind yourselves when you're going through the process, feel free to take your time and be sure that you're asking questions. There's always an opportunity for you to double check with your site coordinator. If you are the site coordinator and you have questions, that's not a problem. That's why we have Steve and Ezra here to be able to work with issues, and I will sometimes get involved depending on how far up the chain we need to go with some tax issues. But our objective is to try and serve as many people as possible. However, it may turn out we may not be able to serve all needs of all the individuals walking into VITA. So if you do have any questions, if you do have any concerns, feel free to go ahead and stop. Make sure that you feel comfortable with the material. There may be some things as we get into areas of advanced topics such as gain on sale of property, or whether it's business income that you may have additional questions or we need to go through that process. So really just want to kind of kick this off, make sure that we can go through a couple of the topics. As what our format will be tonight is we'll go through a couple different areas and then take a break, go through a panel discussion. It sounds a lot more exciting than what it is. It's basically Ezra and I up here answering your questions about the slides we just covered. We'll go through 3 of those areas. We'll kind of go through the first set here being predominantly business income. Go ahead and answer any questions you might have, any concerns, any common situations you may have run into. So we'll be able to take questions at that point in time. We'll go through to a few other topics, mainly capital gains, some discharge of indebtedness, a few other issues with HSAs, and then we'll finish off the evening with military training. Not actually push-ups and sit-ups, but how do we work with military income as it comes through VITA. So first, I want to get started off with talking about business income. This is one of the main areas that we'll see that will require advanced certification, people that have income from self-employment. Generally, what we'll see within VITA is it's not going to be someone who has a full-time business coming in to try and have their taxes prepared. We do not have the time or opportunity to go ahead and take a shoebox full of information and start tallying up receipts. What we're hoping to have is the taxpayer is fairly well organized, that they have the information that they need for us to be able to help prepare the return, and we can use that information within context of what's available under VITA. So up on the screen and in your slides, and also on D13 of your 4012, you'll see some of those conditions that will preclude us from preparing a business return within VITA. One of the things that we're going to see that are out of scope, we're going to be using the Schedule CEZ expenses, which is $10,000 of expenses. I know within VITA you can go up to $25,000 under the Lancaster program. We have a $10,000 cap on expenses. The other issue, we cannot have a loss from the business. So if someone is generating a business loss, they would be outside the scope of preparation. A couple other areas, just because of their complexity, the business cannot have employees. We do not deal with payroll issues, as well as we do not deal with inventory. So if someone is a retail store or actually is a salesperson that maintains inventory, we do not handle the complexities of managing inventory. So that would preclude any things like returns and allowances. Would also, if we have any type of counting inventory, cost of goods sold, that will not be permitted under the VITA regulations. Unfortunately, we also do not do farm income. Given our proximity to many local agricultural communities, we do not handle farm income. There are a couple complex rules with that, mainly with depreciation. So if the IRS ever allows us to do it, we'll probably have a separate section on how long do you depreciate a cow versus a horse, or breeding chickens versus laying chickens, and that's a fun discussion we can have. But really, until we get into depreciation, farming income is not going to be within the scope of VITA. And again, the main reason for that is what we call depreciation. That's where you have an asset that is being used in a business that you're taking the cost over time. While tax layer does have the capacity to do depreciation, depreciation, there's too many complexities involved for us to be able to handle those issues. So if there's a business that has machinery that they need, whether it's something like a landscaping service that's going to purchase expensive mowers, a delivery service that needs vehicles, we cannot depreciate any assets. We can use vehicle mileage if someone does have a vehicle they use in business, so that's acceptable, but we cannot use depreciation rules. Also, a home office. So because a home office is going to be requiring the use of depreciation, that will also preclude a home office deduction being taken for VITA purposes. Most cases, we probably will not see many people trying to claim a home office deduction, but we can talk through what some of those rules look like if they actually have a predominant place of business within their home. A couple other things we're going to take a look at: self-employed health insurance deduction, especially if someone's trying to use that with marketplace coverage, becomes rather complex in terms of the calculation. So we're not taking those into consideration either. So self-employed health insurance deduction would preclude a return from being prepared. Generally, 211 is going to screen whenever someone calls up to schedule an appointment. They're going to ask if any of those items have occurred. Hopefully the individual knows whether or not they have inventory as a component of their business, and will say, thank you very much, I cannot come into VITA. Oftentimes they may not know that they're going to generate a loss from the business, or they may not know some of these questions, which is why they're coming in. So if we do get to that point and you see someone with Schedule C income, they tell you they're self-employed, probably good to start off with that line of questioning before we get too far into the return, before we spend a couple minutes or up to an hour on the return and realize that now we can't do something. Generally, I like to start with some of the complex questions first. That way we can determine whether or not they're still in scope, whether or not they meet the certification requirements at your level, and then we can kind of move on from there. Now, the good part is what is allowable within business deduction for VITA. So advertising expenses, anything that someone is doing to promote their business cards, t-shirts, those are promotional items, those are deductible. What is not deductible is putting a magnetic sign on the side of your vehicle and driving all over Lancaster County promoting your business. The mileage driving around is not an advertising expense. If you're flying down 222, except for tonight, you're not flying anywhere on 222, no one's going to see your magnetic sign that's approximately 8 by 11 when you're driving 83 miles an hour on the highway. That's not going to generate a lot of business, so that's not a business deduction. The cost of the sign is. So the $19.99 that you're paying for the magnetic sign to put on the side of your vehicle is a valid expense as advertising, but driving around trying to promote your business is not. Car and truck expenses are allowable. We're going to take the vehicle mileage. Just want to point out that the IRS does require that you would keep contemporaneous vehicle mileage logs in order to substantiate your mileage expense. In most cases, we have not had much issue with the IRS contesting, but I will mention the Commonwealth of Pennsylvania has been much more aggressive in requiring documentation for business expenses. That includes making sure that a client has vehicle mileage logs. So this is an opportunity for us as we meet with clients here in the beginning of 2018. Not much we can do retroactively. They don't want retroactive records, but they do want contemporaneous. So what it means, if you're seeing someone early in 2018, you may want to remind them that the substantiation rules require that they have a mileage log, and they should probably start putting one together for 2018 if they don't have one already. What a valid mileage log would look like is essentially kind of a diary of where the taxpayer traveled, how many miles they had incurred for business use, and the purpose of the business trip. There is some information within your 4012 that talks a little bit more about deductible business travel. That's found in your itemized deduction section with unreimbursed employee expenses. So we just want to keep that in mind. Some things we do want to watch out for is making sure that we, again, can take taxpayers at their word as long as that seems reasonable and ordinary. If someone says that they've driven 150,000 miles for work that year, probably not unless they're an over-the-road truck driver. That seems relatively excessive if they're delivering newspapers in the county. Again, if they give you an amount and they say, how much did you drive last year for business? And their next question is, how much did I drive the prior year for business? The amount is exactly the same. The amount is not exactly the same. Each year is different. So we do want to make sure that they are keeping some sort of record and providing the information to us. Other red flags can be that they drive exactly 12,000 miles a year, which happens to be exactly 1,000 miles per month, every single month. not taking into account some months are shorter than 31 days. Some months have a little bit more holidays in them. So it does not seem practical that you're going to drive exactly 1,000 miles per month. So again, we just want to inquire from the taxpayer, make sure that they're providing the records and say, we can work with the information you provide as long as it seems reasonable and genuine to us. However, we're not the ones that make the ultimate decision on deductibility. We have a couple other agencies that will do that for you. So just want to remind them of their substantiation requirements. So again, the Commonwealth of Pennsylvania is going to be much more aggressive than what we've seen. Just based in practice, many practitioners are seeing that we get questions on Schedule C expenses, and that can be anything from office supplies to vehicle mileage to any expense taken on that Schedule C. We've been seeing approximately 15 to 20% of all Schedule Cs are now getting a letter asking for additional information. We haven't really seen many come through VITA, and hopefully it's because we don't have as many Schedule Cs. They're not taking large deductions, but it is a concern that we have. So we just want to be sure that we're reminding clients that they are the ones to be responsible for proving those expenses if needed. Okay, but on to more fun stuff. Okay, so what else can we deduct? Any commissions or fees. Typically, we don't see a whole lot of these throughout the process. We may see them as you get into areas such as an Uber driver. They will typically have a commission taken off of their payment back for their driving services. Those are deductible. If you have business insurance, which we highly recommend people have, depending on the industry they're in, that's a deductible expense. If they have interest incurred, so if they're taking a loan out for a purchase of equipment, we cannot depreciate the equipment, but we can take the interest on the loan. Other things we can take a look at is legal and professional services. Hopefully we won't see a whole lot of these because there are resources that they're getting their taxes prepared for free, and we just heard a presentation about how they can get free legal help as well. So hopefully there's not a whole lot of legal and professional fees. However, we may see people that decide that they would like to either incorporate or become a limited liability company. There are some registration fees associated with that, so those would be deductible as well. If anyone does come in and say, I paid to have my business registered as a limited liability company, we can take those fees on the return. So some other things we'll see are going to be our office expenses. Those would be our traditional things, paper, pens, ink, along those lines. It does not include a home office. So any type of expenses we need to help prepare the business would be fine as an office expense, but not the home office itself. If you have to lease or rent any type of equipment, vehicles, that would be fine. So as long as you're renting an item. So this sometimes will happen if we see people who come in and do painting. Perhaps they're renting some ladders or scaffolding for a painting job, or an outside contractor that does some work on the side may need to rent some specialized equipment for a project. They're all deductible expenses. Any repairs and maintenance. So if anyone's doing any type of work, hairdressers may need their shears sharpened. Any type of repair work that you may have on other types of equipment would be fine. Any type of supplies. Again, this is not inventory, but anything that you're using or consuming within a business. So typically where we may see that is a handy person who is purchasing things at a hardware store that are being incorporated within the project. A painter who buys drop cloths and smocks, brushes would all be considered valid supplies. Any taxes and licenses that they pay. Again, if someone needs to have a license, like a hairdresser or someone like that, which needs to be registered with the state, those are deductible licenses. Travel expenses, again, if they're connected in relation to business. So those would be deductible as well, in addition to meals and entertainment. Meals and entertainment for federal purposes, there's a 50% reduction. For PA purposes, that number will be 100%. Again, there has to be some sort of business connection with the meal or entertainment, either happening before, during, or after the meal or entertainment. So if you want to take a client or potential client out to lunch, that's fine, as long as you're talking about business. If you want to take them to the opera or baseball game, that is fine as well. You don't need to be talking about business during those performances. In fact, you'll probably get shushed at the opera if you take someone and try and talk about business. But any discussion before or after would be fine. So they have to be in connection with business. And again, we want to remind our taxpayers to keep receipts. Keep a record of what they actually had spent, not just to produce a Visa bill at the end of the year and say, oh, by the way, all of these restaurants were for business expenses. You want to keep a similar log to say who you had the meeting with, what the business purpose was, and in order to be able to substantiate your deduction. So that prevents people from coming back and saying, I don't have all my receipts, but I found a credit card bill for Chuck E. Cheese. I'm pretty sure I had a business connection. unless you're in a daycare facility, you probably do not have a business connection with a Chuck E. Cheese meal, unless you happen to be trying to recruit 8-year-olds for some sort of lemonade stand franchise you're trying to operate throughout the neighborhoods. So just keep that in mind. We need to go ahead and make sure taxpayers are substantiating their expenses. Utilities can also be deductible. Kind of the interesting issue we sometimes run into are cell phone usage within a business. How much can we take? Generally, probably depends on the type of business. If the business makes sense that they're going to use a cell phone predominantly for business purposes, such as an Uber driver that actually needs to keep an app on in order to be able to accept rides, to keep a GPS, we have a better opportunity than someone who says, I'm a part-time contractor who uses a phone 98% of the time for personal use and 2% for business. The fact that someone can call you on a cell phone does not necessarily make the phone a business use opportunity. What we're going to take a look at is predominant use of the phone. What we get to now a lot is people have family plans or other plans along those lines, so you have to take a look at how do we allocate those expenses. So it can be kind of a unique process, and we can talk a little bit more at the Q&A session about how we handle some of the cell phone expenses within VITA. Okay. So one of the other things we wanted to cover, we kind of mentioned around the topic of Uber drivers. It's a little bit more of an opportunity we see here within VITA. It is providing people who have relatively newer vehicles to sign up for Uber. Process takes about a half an hour. So that's all the time Uber takes to check that your driver is safe and secure in driving around multiple areas. Once you're signed up for Uber, you have the opportunity to open up your app and decide if you'd like to go ahead and make yourself available for rides. So we're going to see a lot more of these throughout our process. Uber has been quickly taking popularity here within Lancaster County and the surrounding region, much to the dismay of the taxi companies. These are essentially people for hire. What we want to take a look at is making sure that we understand how we're going to be getting some information from Uber. Uber drivers are independent contractors. There was some litigation in a few states that Uber drivers wanted to be called employees. The states have said you are independent contractors, not employees. You're using your own vehicle. You're determining whether or not you decide to pick up a passenger. Those are all indication of an independent contractor, not being told when you're clocking in and when you're clocking out. You get to set your own hours, set your own route, so you're an independent contractor, which means you get to pay all of your own taxes. So one of the things that may be surprising Uber drivers is they're going to be getting either a 1099 miscellaneous or 1099K at the end of the year, reporting how much money that they've received. Again, we do need to report if your net earnings are greater than $400. That's our threshold for filing an SE return. That would be calculating self-employment tax. If the amount's under $600, that individual may not be getting a 1099. However, if they come in and say, I have a side business, and you ask how much did you make, and they tell you that they've made money, it's all in cash, once they tell us that information, we cannot ignore that. That's part of our ethics within VITA. So if they tell us that I watch children on the side and I made $6,000, we can't ignore that information at that point. So even if they do not have a 1099, which a lot of our self-employed individuals may not have, the only individuals issuing 1099s are typically going to be businesses. So unless someone's working in a context of a larger type of job, they may not be getting 1099s. But if they have more than $400 in net earnings, that would be considered that they must file a return, even if they're filing thresholds beneath what the IRS would require. Okay, so getting back to Uber a little bit more in terms of some specific information. What we're looking at are car and truck expenses. So when we're taking a look at these, we obviously have mileage reports. The nice thing that Uber will do is give you a nice report at the end of the year saying, here's the amount of income that you've earned, here's the mileage that you've driven, and we can use those reports to go ahead and prepare our expenses. Now, what Uber is going to show are the mileage that you had while you had a passenger in your vehicle. So that does not include any kind of travel between locations. So if you're an Uber driver and you pick someone up here in downtown Lancaster on a Friday evening and you realize that they're going to Quarryville, you're going to be driving to Quarryville. You may not have a returning fare from Quarryville. So we have to take a look at the travel expenses and make sure that as long as it's not your last job of the evening, and that's going to be considered commuting back home, that you can have the opportunity to write off some of those additional mileage expenses. Again, hopefully they're keeping their own logs. If they're not keeping their own logs, it's perfectly acceptable just to use the Uber reports as substantiation. So we're going to be taking the mileage logs and any additional information they have and using a standard mileage rate. They will have commissions and credit card fees that they have to pay in order to go ahead and be compensated. Those are deductible expenses. If they have any additional insurance that they're purchasing specifically for the business, whether it's some additional business insurance or personal liability insurance, or that they're required under Uber to have comprehensive insurance, any of those differences may be deductible. So we need to take a look and see if they have any type of insurance expense. Next one is actually talking a little bit more about interest expense. If they have an interest on their vehicle, they can deduct part of that car loan interest, provided it's only for the business use of the vehicle. So now we have to go in and determine how much of the vehicle is used for personal purposes, how much is used for business purposes, and again, that's pretty much going to be on a mileage type basis. Office expenses. Typically, we're not going to see a whole lot of office expenses within an Uber profession. You really don't need a whole lot of office supplies, other than maybe a ledger to keep some records, maybe download an app to keep your mileage that Uber is not going to keep tracking, but you're probably not going to have a whole lot of other office expenses. You don't need to be printing invoices. You don't need to give a business card out because people are requesting you through the Uber app. So we probably won't see a whole lot of office supplies, but we may see some other supplies. So if anyone is using Uber and they're providing water bottles or candies, anything from gum to hard butterscotch, depending on your passenger and their preferences, those are deductible supplies. Other things to keep in mind, cleaning supplies. If you're going to be hauling strange people around in your car, you may want to have some cleaning supplies with you. If you like to put a nice terry cloth towel down, if you're going to pick up someone near the Susquehanna River after they've been out tubing or fishing all day, probably makes sense to keep your seats nice and clean. Those are deductible supply expenses. When we do take a look at utilities, the business portion of the cell phone can be deductible. And that's when we see with Uber drivers, there's more likelihood that they're going to have a business use of their phone. Again, they're using the GPS app. They're going to be using the application within Uber to determine whether or not they're going to pick up a passenger. They're going to have all the payment information through that process. So more likely that they're going to have some element of a business phone as a deduction. Question also comes up, Uber does not typically have tips built into their process. However, quite often people will slide cash to an Uber driver. If an Uber driver has tips that they wish to report, we need to add that into their Schedule C income. So if they let us know, oh, by the way, here's how much I had gotten from Uber, but I also get about $20 per night that I'm out driving in tips. That is something that we would need to add to their Schedule C. Typically what we're going to see is if the Uber driver has not maintained a detailed list of records, hopefully their Uber page will. So that'll give us pretty much all the information that we need to be able to come up with their amount of income earned, their commissions that they've paid, the amount of mileage that they've driven. From that, we can probably derive how much they have in business cell phone usage and come up with some sort of amount for how much they pay for peppermint candies and small water bottles. Okay. So want to get to another area that we typically see within our process here within advanced certification, and that's dealing with capital gains and losses. So capital gains and losses are typically going to arise when we have individuals who have investment accounts or have stocks or bonds or mutual funds. Whenever one of those stocks, bonds, or mutual funds are sold, they're going to be getting a 1099-B, which is going to be reporting sales proceeds. The general rule of thumb, whenever you see something with a 10, a 0, and a 9 in it, it means the IRS is also getting a copy of that document. So if we get a copy from the taxpayer, we should be inputting that information within the return. So fortunately, our program is fairly easy to go through and enter gain or loss detail as long as it's only a handful of transactions. So we'll kind of go through a technique of how we can use that if we have more substantial detail with their gains and losses. But a couple things that we'll be looking at, traditionally the things that are going to be in scope within VITA are going to be the sale of stocks, sale of bonds, sale of mutual funds, sale of a principal residence. If someone comes in and says they have a foreign trust account in the Cayman Islands and they have some unique transactions with foreign derivative swaps, you want to thank them for their time, pack up the materials, and suggest they go elsewhere, because we're not going to be dealing with some of those issues. Predominantly, what we're going to see within VITA is someone coming in with a 1099-B from their broker with a lot of this information provided. So the things that we're going to need to know the sales price. which if someone has information from the broker will be listed. We also need to get the adjusted basis of that asset. We'll talk a little bit about what that 1099-B will look like, but in a lot of cases we'll actually have the adjusted basis of the asset reported on there. The problem is if we don't have it, we're going to have to make sure that the taxpayer is going back to their broker to get that. We cannot help them derive their basis. So if you ask them, how much did you pay for your stock you just sold? And they said, I have no idea. My husband bought it in 1956. I have no idea what the stock basis is. We're going to have to refer them back to their broker. Either the broker may have that cost basis information available or can help them recreate it. We can't really help them come up with a basis number. The IRS can't really help them come up with a basis number unless you like the IRS's number, which happens to be 0. They will gladly give you a number for basis, which happens to be 0. But we know they probably paid something for their stock, so we probably want to send them back to their broker to help them through that process. So this is an area where it's perfectly fine that we have started the return and we need some additional information. Most of our basic returns we can generally finish while they're there. Some of these advanced issues we may need to simply put aside and have them gather some additional information and come back later to finish those. So once we have the sales price, once we have the basis information, we're going to take a look at the dates of the transaction. We need to know the purchase date and the sale date. That's going to determine whether it's a short-term or long-term gain. Short-term gain is anything held for a period of 1 year or less. Anything held for a period of more than 1 year is a long-term capital gain. The benefit of long-term capital gains is they have a favorable tax rate, which for almost all of our VITA clients will be 0%. So if they have long-term capital gains, they will generally not pay any federal income tax on those capital gains. I will warn you, it does look very weird when you take a look at a return that has a substantial amount of long-term capital gains or qualified dividends that also get those same rates. Because what will happen is you'll see taxable income, and you're expecting there should be some element of tax, but there is not, or at least a much lower one than what you were expecting. That's perfectly reasonable. You don't have to start sending out emails. Everyone stop what you're doing. The system is not working right. The calculations are all off. It's probably the system is doing the right thing. It's going through the iterations of our long-term capital gain rates. So we do have some benefit with that. So we do want to take a look. Usually the brokerage statement, particularly if they're short-term, will have the buy and sell date in. Sometimes for long-term, you'll just see a column called various. We know that they're going to be long-term if they're reporting the long-term column, so we do want to go and make sure that we have that reported correctly. One thing we do want to watch is capital loss carryovers. So much of an issue last year because we did not have any information coming over from the prior system. Take a look at the prior year return. One area that you can generally see if there's probably an issue with capital loss carryovers is look at the front page of the return. If their capital loss section for the prior year showed a $3,000 loss, odds are they probably have a capital loss carryover, unless they were incredibly lucky that they had exactly $3,000 of losses for that year. The reason why is the IRS only allows up to $3,000 of capital loss per year to offset other income. Any amount in excess is carried forward to future years indefinitely. And what we want to do is keep track of that schedule. It's a very valuable asset that people can use to offset future taxable income. So we don't want to lose that. So take a look at the return. If there's an amount of $3,000 sitting there on capital loss from the prior year, take a look at the Schedule D from the prior year. Usually page 2 will go through all the detail of how much they have. So what we want to take a look at is what that amount for capital loss carry forward is and put that in the return. If they came in last year to VITA, that amount should be carrying over from the prior year. Yeah, Dominic, question?
That just happens to be one of the problems you had. Carryover, I'm not sure, maybe getting too detailed right now.
Okay.
Where we enter that at.
Sure, okay, so within Tax Slayer itself, okay. And we'll take a look at that. I think probably when we get back to our panel discussion, we'll see if Ezra has any tips, and if it's something we need to make a little bit more of a note within our tax training itself of where some of that detail should go.
Okay.
Yep, sure. So capital loss is one thing to take a look at. We will be talking about sale of a principal residence, a couple more slides here, and we'll talk about why that becomes an issue, not just for federal purposes, but for PA. So again, just to kind of reiterate what we have for the capital gains, we're typically going to be seeing this coming through a 1099-B. If you get a 1099-B, again, it means the IRS is also getting a copy of that document, so we should be reporting that information. We may have that if you're selling stock, securities, mutual funds, bonds, those types of things will typically be coming from the broker. If you have stock held directly, whoever's holding your stock for you will also issue a 1099-B. Typically what we'll see is that that information will contain purchase date, sale date, initial cost basis, and what the proceeds are. It may also have a couple codes behind it as well to tell where we're going to be reporting that within TaxSlayer. Codes of A or D means it's essentially a transaction in which the basis is being reported to the IRS. Schedule or B or an E classification means that the basis may be reported to the IRS. And usually that will have some information within the 1099 system. If you see a C or an F, it may mean that they have no idea what the basis is. So that's generally an indication we need to have them do a little bit more research before we can complete the return. Sometimes you may want to take a look at the 1099-B. Oftentimes the first page mainly reports some of those covered securities, meaning that the broker is required to report basis. But sometimes if you go to the back, depending if it's a large statement, there may have some additional supplemental information that they've calculated the basis for you, they just did not report it to the IRS. So before you kind of send people off, you may want to just double check, go through the document, be sure that we actually do not have that basis information. If there is something in the back, we can go ahead and use that. We just can't have any unknowns in that process. Okay, so basically what we're going to do is we're going to use the information we get right off the 1099-B and enter it in a TaxSlayer. Question always comes up, what happens if we have multiple transactions that are pages and pages and pages? And unfortunately, I've seen this before. I've seen some people on fixed income and they have investment accounts. They have a couple mutual funds. And the broker thought it'd be a great idea for them to get their $2,000 per month out of the account by taking of the 20 funds they have and taking $100 out of each one every month of the year. So what does that mean? Well, now we have 144 transactions of stock, all at about $100 sales price each, which take an exceptionally long period of time to enter into our tax software. The other problem we run into, not only is it time consuming, but it's also much more of a high likelihood we have an input error. So if we have those types of situations, what we can do, if we have the summary information from the broker, we can actually enter that information and say it's brokerage account, short-term transactions, put the total in, total cost basis, and allows us to go through that activity. What we're supposed to do with the IRS is if we do that process, we can either scan and send the information electronically with a return, which we do not have the capacity to do within VITA, or we can go ahead and make a photocopy of all those documents and send them to the IRS. We can still file the return electronically, but it's with a form 8453, which is essentially kind of a cover page that takes all that stock information and sends it out to Austin, Texas, where I'm envisioning a giant warehouse that gets tons of paper documents that the IRS may never view, but it would complete our activity. In the past, I think we've had sites that have just said brokerage account, short-term, brokerage account, long-term, and that's all the information they get, and we've never had a question before. So we'll talk a little bit about kind of practice of how that works. The recommendation from the IRS is obviously to copy the documents and send it to the service center with the form 8453. All right, so again, we talked a little bit about those long-term gain rates and how that's very, very powerful. Again, that's only for federal purposes. So federal may have a 0% rate. The state of Pennsylvania, the Commonwealth, only has one rate, 3.07%. The other issue we run into within Pennsylvania, not that we can really do much about it because we're not doing tax planning for clients once they come in, but if you have losses from a spouse in their investment portfolio and the taxpayer has gains, you can offset those on the federal return. You cannot offset those on the state return. So the taxpayer is going to pay income on the gains that they have, and those spouses' losses will be lost forever. There's no carryover, no carry back. So Pennsylvania does not have those same rules. So if someone says, well, I don't know why we didn't have to pay tax on that for federal purposes, but we're paying much more in tax, and maybe we're not eligible for tax forgiveness. Now, because one taxpayer has gain income, that's what happens. Pennsylvania will not allow taxpayers to offset losses with spouses, nor can you offset losses from one item of income with another item. So you may just want to watch for that. Just want to make a quick mention about the sale of a principal residence. We don't often see that here within VITA in terms of having a taxable calculation. The main reason is generally each taxpayer gets a $250,000 exclusion. So when you get the call coming in 211, we're probably not seeing a whole lot of people that have sold their home here in Lancaster County and having a more than $250,000 gain each. That is if they meet the qualification rules. And the qualification rules are the same for federal as they are for Pennsylvania purposes. You had to have lived in the home for at least 2 of the last 5 years, and you had to have owned the home for at least 2 of the last 5 years. The odd part is they do not need to be the same 2 out of 5 years. So if you read some of the IRS publications, they come up with all these bizarre examples of how it's possible for you to have lived in a home for 2 out of 5 years, where maybe you rented it, you loved it so much you decided to buy it. 2 months after you bought it, you decided to move out, but you still own the home for 2 more years before you sell it. You meet the qualification rules. That's 2 out of 5 years. They do not need to be simultaneous. They just need to be 2 out of the last 5 years. If they meet those rules, it's a $250,000 exclusion per taxpayer. So if they're married, it's a $500,000 exclusion. So safe to say, most people coming into VITA will not have a gain of more than $500,000 on the sale of their residence. Again, that would push them well over the $62,000 income limitation that we have. A couple things we do want to point out. If they do get a home sale, generally we don't even need to report the sale of a home on the federal return unless they receive a Form 1099-S. 1099-S is essentially a brokerage type form that's reported at the sale of a home, traditionally handled by the settlement agent. In most cases, if they know it's a principal residence, they will not issue a 1099-S. There may be some indications that they aren't quite sure. I've seen 1099-S's mainly on vacation homes, second homes, vacant lots next to a principal residence. If that's the case, we need to report that on the return. Again, it's a 1099, so the IRS will be getting a copy. If they get a 1099-S and they do meet the qualifications, it's actually a simple process within TaxSlayer to go ahead and just check the box, qualified home sale, eligible for exclusion. It's going to put the amount of gain, the amount of sale proceeds, and the adjusted basis will be the exact amount of the gain. So it's just going to go ahead and zero that out. If for some reason we need to determine how much gain or loss they actually have, and someone says, well, that's a fairly high federal limit, why do we need to know this? If you recall from last week's training, we talked about state and local issues. Pennsylvania, while they will exclude the sale of the home under the same rules as federal, we do need to add the gain from the sale of the home in for purposes of Schedule SP and the homeowner rent rebate. Those are add-back items. So there's no exclusion for those 2 forms. So we do need to inquire about how much they had in gain for purposes of SP and for the homeowner rent rebate claim. So how do we determine that? Well, we know what the sale price is. That's coming off the settlement sheet. But your cost basis is whatever you paid for the home, whatever closing costs and some other costs that you had at the time you purchased the home, any improvements you made to the home over that period of time, adding on bedrooms, resurfacing driveways, replacing the roof, all of those are costs of the home. And also when you sell the home, your brokerage or commission costs, your settlement charges are all part of your cost as well. So we may need to go through some calculations just in order to see where we're at with our SP or homeowner rent rebate. But as you can probably tell, those levels are fairly low. If someone says I have a $70,000 gain on my house, guess what? They're not going to get SP or tax forgiveness or rent rebate anyway. They're going to be well over the limits. So we don't need to try and go into minutia for some of those. If it's relatively close, it may make sense for us to go ahead and go through that process. Hopefully people have those records. Again, we can't go back and tell them how much they paid for their driveway that they installed in 1964. They'll have to try and go back and provide that information to us. Okay. Yes?
The driveway.
Yes, sir.
The driveway, when you purchased it, was not a driveway, it was just put in an asphalt driveway. I understand that's improved.
Yes.
But you bought it with an asphalt driveway and it declined over time, which
yes.
asphalt does.
Yes.
So actually, you got to resurface this.
That technically counts as an improvement as well. So if you're doing new siding, if you're doing a new roof, if you're doing new windows, all those are considered improvements to the residence. You're actually improving the efficiency and operating condition of the property. So for the IRS rules, those would be considered increases to basis. Technically, not that we get into rental situations, but painting, new carpeting, all those other things would count as well. Yep. So the odds that someone kept 35 years worth of receipts for every home improvement that they've done may be a little remote, but if they have and they provide us a number, we can certainly use that. Okay. So one of the questions we had earlier when you had got to hear from the attorney talking about some issues on debt forgiveness, we want to talk about what's within scope in terms of debt forgiveness within VITA. So typically what we may see is situations where individuals may have incurred a substantial amount of personal debt. The only debt we can work with in terms of VITA is personal debt. It cannot be business debt. It cannot be associated with any other type of business. It also cannot be in connection with a bankruptcy, so that's going to take us out of those contexts. What it has to be is traditionally personal debt, which may be something like an auto loan. Frequently what we're going to see are things like credit card debts. Now that we're out of the political race season, the ads on TV and radio have gone back to car commercials, also just kind of holiday sales, and credit consolidation or credit debt forgiveness programs. If someone goes through a debt forgiveness and they have a credit card bill that is, say, $5,000 and they realize that they just can't make payments on the credit card anymore, they can negotiate either with a credit card company or through a debt management company to reduce that balance that's owed. So if they have a $5,000 debt and all of a sudden they negotiate it down to $2,000, they have essentially benefited from $3,000 worth of stuff. We don't know exactly what the stuff is, and we don't need to ask what the stuff is. So they got $3,000 worth of stuff, whether it's food, clothing, travel, transportation, whatever the case is. They have an economic benefit of $3,000 that they do not need to pay back. So under the IRS, that's income, because they've gotten an economic benefit that they do not need to repay. So if there is debt forgiveness, we're typically going to see that through another 1099 form, a 1099-C. Again, the IRS will be getting a copy of the 1099-C, so we need to report that. So within scope in VITA would be if it's a personal debt. It's reported on the form 1099-C. It's not in connection with debt. There's no interest associated with it. That's really only coming into connection with our next point being not business related. It's not going to fall under bankruptcy, and we're not claiming the insolvency exemption. The insolvency exemption is going to take a look and see how much does a taxpayer have in assets, how much do they have in liabilities. If after the debt discharge they are still have more debt than they have assets, as you heard earlier, that amount is not subject to tax. However, we do not go through the calculation of insolvency. It has to go through basically taking a look at their assets and their liabilities as of that date. This would be a great opportunity to refer them over to our Mid-Penn Legal Services for additional assistance. Yeah, Dominic.
About tuition forgiveness.
Well, tuition forgiveness, are you talking about a student loan being discharged? As long as it's reported on 1099-C, we can go ahead and cover it. If it's not reported on 1099-C,
Is that income?
if it's in connection, yes, it would be considered income unless it's under a federal program for healthcare or service-based workers.
I understand
Yeah.
that part of it. So all this hoopla that's on TV and everything we hear now is forgive your tuition.
Right.
It's good in some respects because you have a debt, but people really need to realize that they're still.
Yes. If, yeah, right. Sure. Yes, absolutely. So if you had gotten the benefit of something and you do not need to pay for it, that's going to be an item of taxable income. So the IRS will carve out a couple exceptions. Gifts and inheritance are not taxable. But if you've incurred something and you had the expectation of repayment and now you do not need to repay it, that's going to be an item of income that needs to be reported unless there's some other type of exclusion. If they had gone through school and they had gotten a non-taxable scholarship, that's a whole different story. That's going to reduce the amount because we don't know if someone had taken the American Opportunity Credit on borrowed funds, which you're allowed to do. So if you took a credit and now you don't need to pay the money back underlying the debt. It only makes sense that you need to pick that amount back up as income. And you're only going to be paying tax on the difference, not the full amount. So not the full amount of discharge will be taken away from you. Yes?
Yes, I had one of those last year, got the 1099-C, and it was like $1,200 or something like that.
Yeah.
And all I can tell is personal debt, and I had 1099-C, and it was easy to plug into the tax code.
Yes.
It was good. But I don't know about, how do you figure out the 4 other points under the 1099-C?
Right. Yeah, so basically with those types of situations, we're going to presume that most people coming into VITA will not have that in connection with the business debt. Because what it would have the business name on the debt. So that would be basically if you had a little bit larger of an opportunity, if you were, say, a New York City hotel magnate that has bankruptcies on his buildings on occasion, it would be under a debt discharge within the company name, not personal name. Likewise, if you're going through a bankruptcy proceeding, they're probably going to let you know that they're within bankruptcy. The interest component, again, is only going to be related to a business-related debt. Since we don't get a deduction for personal interest, we don't need to worry about forgiveness of personal interest itself. So it's just mainly recapturing a couple things that people may have taken. So in most cases, you may have someone who comes in, and was that a credit card forgiveness? Yeah, and that's the most common situation we're going to have, is someone who comes in and says, I was able to negotiate my credit card, they sent me this form, I don't know what to do with it. Well, we know exactly what to do with it. It's going to be going on line 21, and TaxSlayer puts that in effectively. The nice part is it's not taxable for PA. So personal debt forgiveness is not one of the 8 classes of income, so it's not taxable for Pennsylvania. It's not considered earned income, so it's not taxable for local purposes either. So it's just going to be reported on line 21 of the 1040. Okay.
Does TaxSlayer automatically exclude that from Pennsylvania?
It should, yes, it should not. TaxSlayer should know there's no place for it to go on the PA return. So typically, it won't even be reported on if you're used to seeing the PA return, there's a scheduled W-2S on the back that'll report all your W-2s and your 1099-Rs. It should not even show up there. Okay. Just a couple other little points that we have before we take our next panel discussion is taking a look at some areas of entering K-1 information. Now, we don't see these very often within VITA, but if we do have the ability to enter those into VITA. The main thing to keep in mind, if TaxSlayer has a box for you to enter it, and there's a box on the K-1, we can do it. If there's boxes on the K-1 that don't have a corresponding entry point on TaxSlayer, it's now out of scope. Now, for the most part, we're not going to see many of those types of K-1s. Most of our people coming into VITA may have a K-1 coming in because they were a beneficiary of an estate, so they might be having a K-1 from a Form 1041 come in. Maybe they have an interest in a partnership through their investment account. That would be reported as well. Hopefully, we don't have people involved in mining and gas exploration publicly traded partnerships. They have a little bit more complexity associated with them. So if you get a K-1, it can either be coming out of a partnership or LLC, that's going to be off of Form 1065. It can be off of an S corporation, which is a Form 1120S. Could be coming out of an estate or trust, that'd be a Form 1041. When you go into TaxSlayer, it's going to ask, where is this coming from? Because the boxes are going to be a little bit different for each K-1. So all you have to do is just select which one of the forms that you have, and the K-1 will indicate where it's coming from. S corporation, partnership, or estate or trust. So you can simply follow it. As long as every number that's on that K-1 can fit in a TaxSlayer somehow, it's still within scope. What we're going to do is just be sure we're going through the right K-1. What we're going to get to is a question set at the bottom. Again, we also want to make sure you get taxpayer spouse down there correctly, or joint, mainly for PA purposes. But you'll get to a question that says, is this a passive activity? Most cases, the answer is going to be yes. And they're also going to ask, are all your investment at risk? That answer is also going to be yes. So when you get to it, we're going to be checking passive, all the investments at risk. And that's going to basically just trigger a couple things. Mainly for the fact it's mainly used for losses on the K-1. It's going to limit some of the losses that we take. There's no restriction on what happens on the income side. But typically what we're going to see is going to be a passive activity with at risk. And we can go into a whole discussion on passive losses and at-risk. I just worked with my students up at Elizabethtown, and we spent about 2 days talking about at-risk and passive losses. But suffice it to say, what we'll do is we'll just give you the warnings to say, check the passive box and the at-risk, and we're fine. So we'll be good to go with those. If you want to take a look at it, it is on D48 of your 4012. We don't see a lot of these, but again, if you do get them and you have advanced certification, they're relatively easy to enter into TaxSlayer. So again, we mentioned if you have numbers on the K1 that don't fit into TaxSlayer somehow, it's out of scope. So again, kind of the caution we run into, if you have an advanced return, probably start with those uncommon issues first. Before you've gone through and entered all the W-2s, a 1099 interest, a 1099-Rs, a Social Security statement, and then you get to a K1, you're like, uh-oh. Now we have a problem. So probably start with those things first. All right, one other area that we do want to talk about, which is a separate certification, is the HSAs, health savings accounts. I will say, of all the exams, other than probably the intake exam, this one's relatively straightforward. HSAs are part of the advanced certification. They have a special test that you need to take. But HSAs are relatively straightforward to work with. Just by show of hands, how many of you have worked with HSAs before? Okay, good. Well over half the crowd. That's good to see. So what we're looking at with an HSA is essentially just understanding what the program is. It has arisen out of the whole concept of high deductible insurance plans. So as part of the way to contain medical costs, some employers or even directly from the marketplace are offering high deductible plans. Generally recommended for people who do not have a lot of medical conditions and don't need to see the doctor. Because what happens is their insurance doesn't kick in until they meet a relatively high out-of-pocket cost. So the high deductible plans have a relatively low monthly cost, but a high amount of out-of-pocket expenses before insurance kicks in. Now, because there's some risk that you may have some issues of illness, injury, or sickness, and all that money has to come out of your pocket, a new program was implemented several years ago called a health savings account. It allowed taxpayers to put money into a special account to be used only for health-related expenses. So when we take a look at what those are very, very similar to what we'd find on Schedule A medical deductions. Those can be your medical copays, your doctor's office visits, your prescriptions, your eyeglasses, your dental visits, anything health-related. And there's a couple exceptions. You may want to take a look at E4 that'll go through what some of those are. As long as they're used for those purposes, distributions are going to be tax-free. So that'll be the second part of the slide that we'll cover here. Where we're typically going to see this happen is we may be seeing individuals having contributions to that health savings plan. Quite often an employer may incentivize employees to pick that high deductible plan cost because it costs the employer a whole lot less money to go ahead and implement a high deductible plan. And if they incentivize an employee by saying, if you pick the high deductible plan, we will put $1,000 into your health savings account. That's generally going to be reflected on the W-2. So if you see a W-2 and we see something in box 12 with the code W, that's an employer contribution to an HSA plan. We do not get a second deduction for that. That's actually done on a pre-tax basis. But we can inquire to see whether or not the taxpayer had made any after-tax contributions to an HSA. And the reason why we want to ask that is because we get a federal deduction for that. That's an adjustment to income. We don't even need to itemize deductions to take an HSA deduction. The other benefit is a deduction for PA purposes as well. So an after-tax contribution to an HSA will reduce your Pennsylvania taxable income. So if we see a W-2 with a code W in box 12, we know that's an employer-funded portion. That's not an employee-funded. That'll automatically carry over from TaxSlayer and show up on the 8889. The nice part about HSAs is we typically get 2 documents a year from the HSAs. One is a Form 5498, which will show contributions to the plan. So what we want to do is compare how much contributions were made versus how much were made by the employer, and just ask the taxpayer. Shows that $3,000 went into your HSA for the year. We see on your W-2, $2,000 came from the employer. Did you contribute $1,000 to the plan after tax? If they said yes, or my parents did it for me, we can go ahead and take that on the Form 8889 as an after-tax contribution, which reduces their federal taxable and Pennsylvania taxable income. So the contributions are fairly easy. Most of them are going to be coming through the employer, or they may have contributed some on their own. It's a very nice benefit. So when we talk about the HSAs, what we're doing is we're building the savings account. The nice part is it's portable. You can take it with you. It is your own account, and you can use it forever. So if you're in an employer and you have a high deductible plan, and you build up a nice reserve, and later you go for another job or you change to a traditional plan, those health costs can stay with you. You can still have that plan earning interest. As long as you're only taking the withdrawal for qualified medical purposes, it's tax-free. So you got a tax deduction on the way in, you get tax-free benefit on the way out. So it's a great plan. In fact, a lot of people are calling it the new Roth IRA for mainly used in retirement. So for people who are in Medicare and you have those other payments that you need to make, the health savings account, if you had it established already, works great. Problem is, if you're on Medicare, you cannot establish a health savings account. So what we're going to see is that we're going to get a distribution form that's going to show how much someone has taken out of their HSA. It's a 1099 SA. Apparently they left the H off of it, so it's a 1099 SA that'll show how much they've taken out of their health savings account. But what we'll see is that there'll be an amount shown as a gross distribution. What we want to do is ask the taxpayer, how much did you have in medical expenses? Did you have as much as you had taken out? In most cases, the answer is probably yes. That I had taken money out of the account to go pay for my medical bills, my co-pays, my eyeglasses, my dental visit, whatever the case may be, and we simply put that amount down. So as long as the amounts match, we're in great shape. What's the downside? Any amounts you take out that are not qualified medical expenses are not only taxable income, but if you recall, a couple weeks ago, we had talked about the 1099-R, and that code 1 sitting in box 7, which triggered a 10% penalty. And that was about the worst thing we had talked about all training season so far, right? The HSA penalty is 20%. So it's a very big stick that the IRS puts out there to go with their big carrot. So if you take money out of the HSA early, you're going to have to pay tax on the amount that you take out and a 20% penalty on top of that, which will automatically be calculated by TaxSlayer, so we don't need to do anything. So hopefully in most cases what we're going to do is see that people are taking that out only for qualified medical purposes, not for that they see they have a savings account and they realize that they can go get a brand new flat screen TV or put a deposit down on a shiny new car. Not the best account to go ahead and use for that purpose. Yes?
Not be used to pay premiums.
Right, so there's some limitations on premiums. So if you take a look at the E4 in your 4012, it'll go through a list of qualified expenses. So yeah, you'll have some limitations on some premiums there. What we do have, if you have any questions about the HSA, Pub 969 is a great resource, particularly if you're taking the exam, or actually the instructions to the 8889 are actually fairly good in terms of instructions go for IRS forms, so it's fairly straightforward with those. So one of the things we want to talk about is kind of a specialized area within the tax code, and that relates to members of the armed services. In years past, we have been turning people away from the VITA program because we were not going through the certification process, mainly because it was another credential that we could add within the training process, and there are just a couple areas of complexity related to kind of military pay and military deductions. However, we've seen a lot more opportunities for us to serve the community by offering that training and offering a little bit more opportunity here for getting that certification. And so we want to spend a little bit of time tonight just kind of talking a little bit more about what are the issues that we have with members of the armed services. And importantly, even if we don't have a lot of active service military here, because we don't have an active military base within the region, but what do we do with people who are in the reserves? And there are some special deductions that we can take for reservists. And we'll talk about some opportunities there that maybe we haven't seen in the past, mainly because we've only been offering military certification for the past, last year was the first year, this will be our second year. So hopefully we'll see a little bit more influx in people who are interested in coming into VITA. So if you do see one, yes sir.
Just a note, this year won't roll, but next year it may be, because I just heard the radio that the Central Pennsylvania unit of battalion, National Guard being deployed to Kuwait,
Okay.
Jordan, and the next, for all of 2018.
Okay, all right. So that's going to give us an important distinction in terms of military compensation. And we'll talk a little bit about that as we get into kind of some differentiation of what's going to be taxable, what's not going to be taxable for both federal and state purposes. But the main concept we have is because this has only been around for last year and now this year, if you do see some military issues, again, don't hesitate to say, hey, this is kind of unique. We need to take a little bit of a look at it. If you do see it, kind of the advice from Ezra is to share. The more we get to see it, the better opportunities we have. So if you do see something unique, if you ever have seen a pay stub or really a W-2 from a military institution, a lot of unique things on there. Some codes that you'll probably not have any idea what they mean. But the more you see them, the more you understand really what some of those codes are in box 14. And we'll talk about a little bit more of kind of how we're going to treat those. Generally, we're going to assume the W-2s are prepared correctly. I'll give you some examples of why they may not be, but we can kind of go through some additional detail. One of the other things we take a look at is while the 4012s generally are primary guide for return preparation, you're probably going to get more information out of the 4491, which is a companion publication that's available online. So the 4491 actually walks through a lot more military concepts and issues than the 4012 will. 4012 is really kind of a nice guide to get things into tax layer, but the 4491 will give you a little bit more detail into the tax law behind what we're looking at. So mainly we're going to divide this discussion up into a couple different areas. One's going to be taking a look at our income. So the predominant area of income obviously from the military will be coming off the W-2. Just a word of caution, the military as well as the U.S. government tends to try and find the lowest cost contractor to provide their administrative services. Lowest cost contractor often means they may not be the best contractor for providing said services. So that being said, if you see a W-2 that looks incorrect or you have someone who comes in and says, I don't understand this is completely different from what I had gotten paid, maybe we do want to take a look. I haven't seen a whole lot in the VITA context, but I've worked with a number of physicians in the VA system, and for years their W-2s have been prepared incorrectly. It has to do with some moving bonuses and a couple other things that they had gotten, mainly because the pay company had continued to pay bonuses after they should have been stopped after a couple months. So they had a couple issues that over-reported income, then they started taking income out, but that had not done it correctly. So hopefully we won't see that. But what we're going to see is there are a bunch of codes in your 4012 on D2 that'll indicate which items are going to be taxable, which items are going to be excluded from income. So basic military pay will be included in the W-2. Combat pay is an excludable item. Now the interesting part about combat pay, if you have combat pay, you do have the option, what we'll talk about is allowing that to be calculated for earned income tax purposes. So it's an election you can make to actually include it in your earned income calculation. You can either choose to do or not do the combat pay. It's going to be on a separate schedule or a separate code here in the W-2. So again, take a look at the W-2. There may be some unique items on there. If you have any questions, take a look at your 4012. The other thing you can do is flip the W-2 over. All the excuse me. All the codes in box 12 will be listed on the back of the W-2. Box 14 will probably have some unique things that you may need to ask. Exactly what do those mean? Sometimes there are going to be some additional areas of housing allowance, some additional benefits they might be entitled to, so you may just want to inquire if we can use any of those. So generally what we're going to take a look at here is the W-2 impact. We're going to take a look at some deductions and also some state and local issues as well. So one of the other areas, in addition to taking a look at combat pay, we may have an opportunity that someone is receiving severance payments from the military. So if they've been discharged from service and they're receiving a severance pay, it can be based on either separation from service due to retirement, or the issue that we've run into a little bit more is separation of service due to a medical condition. So as long as it is still considered severance pay, it is going to be taxable income. Quite often the service member may be going through an administrative procedure to have the disability classified as a disability compensation award. So if there's an injury that prevents them from continuing in military service and the injury was related to their service, they may be changing that to a disability compensation award. That process may take a little bit of time. So what we do is we take a look at the W-2. If it's reported in box 1, we need to report it in box 1 on the return. But we can go back and take a look. If the compensation award comes back that it is a disability, what will happen at that point? The military will go ahead and change all future payments to be non-taxable. But that does give us an opportunity to go back and amend prior returns, because now that compensation has been deemed to be related to a specific injury, and injury payments are not taxable. So if you do get someone who comes in and says, I'm getting separation payments from the IRS or from the government because of my separation from service, if it's in box 1, we need to report it as taxable income. But we want to remind them, if they do get an award letter, then we can go back and amend their return and treat it as non-taxable income. And the letter will have the date of incident, so it will allow us to go back and fix those awards. So generally, we're only going to see that issue typically in the year in which that award was determined. So again, just kind of one of those areas to take a look at in terms of settlement payments. So traditional severance is going to be taxable. Severance on medical condition will be taxable until a disability award comes through. Okay, and as we mentioned, kind of combat pay issues. So combat pay, if they're serving in a combat zone, which based on the status, if they're being activated from the National Guard, will generally be considered combat pay, will be non-taxable. So if you're serving in a combat designated area, that pay is non-taxable. It's going to be shown in the W-2 on box 12 with a code Q. So that's only used for military purposes. Again, we have the opportunity to put that income in on the EITC schedule. So it can be added for earned income credit purposes if needed. So just an option that we can take a look at there. So it doesn't have to go there, but if it can benefit the taxpayer, we have the option of including it as earned income. Generally, some other things that we see, your basic housing allowance and homeowners assistance are generally not taxable as well, so they will not be reported as taxable income. Bless you. So some things we may see are moving expenses. Now, we may not see that a whole lot within Lancaster County, again, because we don't really have many, we don't have any active bases here within the local region, but we'll talk a little bit about some moving issues. But before we get there, just want to kind of mention what the state and local rules are for military compensation. So the rule is, for Pennsylvania, if you have indicated Pennsylvania is your state of residence when you entered the service, which is essentially when you declare your state of domicile, your wages will be taxable for PA purposes unless you are on active military duty and you're serving or training outside of Pennsylvania. So you have to be active military and you have to be outside of Pennsylvania. If that's the case, then that will not be taxable for PA purposes. What's one of the problems we have? Again, the lowest paid contractor is determining what's taxable and what's not taxable in PA. So oftentimes you may get someone who comes in and says, I've been serving, I'm active military, I've been stationed at Fort Hood, Fort Dix, I've been out of the area for training. Those amounts would not be taxable for PA. So the W-2 may be incorrect. And what we need to do is to go ahead and prepare the return using the correct information. So what we need to do in that case is we're going to send the return to PA. We're going to send some copies of the information. So we need to send the W-2 and we need a copy of their military orders. So if they have their orders that basically detail where they were stationed, that will suffice to say what amount of income would not be subject to tax. If for some reason we can't get the military orders, you can have a statement by the commanding officer. So it depends whether or not the commanding officer is you're on good terms and is willing to write the letter. Sometimes it's better just to get the military orders and attach that to the return. But in order to adjust the W-2, we need to have a copy of the military orders or a commanding officer statement. PA does have some information. There's a special brochure that just talks about military pay within the Commonwealth. That's the REV 612. You can go ahead and Google that. I suggest you put Pennsylvania in front of it. I haven't tried the REV 612 to see what it brings up. Might be an owner's manual for some other kind of electronic device, but if you put Pennsylvania REV 612, that'll bring up the brochure on Pennsylvania military income, what's taxable and what's not taxable within the Commonwealth. Again, when you sign up for military service, reimbursed, you're indicating your state of residence. So if you indicate a PA, everything's going to be taxable to PA unless you're active military, serving or training outside the Commonwealth. So when we talk about kind of moving, the opportunity to move between bases, generally what will happen is the military will offer to move you for a permanent change of location. If you're getting the military to move for you, it's going to be a tax-free benefit if they're moving your personal effects from one base to another. A lot of people have the option to say, I'm not going to have the military move, I'm going to go ahead and arrange my move on my own, and we'll talk about that one in just a little bit. But when the military is going to move you, any of the cost of moving your goods, your personal effects are going to be deductible. Or not includable in income if you're letting the military go ahead and handle that. So your travel, cost of moving your personal effects are going to be an item excluded from income. If you take a look at doing the move yourself, or if the military is reimbursing you, any amounts that you have incurred for moving, again, personal effects, the travel portion, the lodging, but not food, so food's a personal expense, but the cost of moving your items from one base to another and the cost if you have an overnight stay are considered deductible moving expenses. So if you have any costs in excess of what you were reimbursed, you can actually take that as a moving expense. That's a Form 3903, that's an adjustment to income. So any amounts that you have, again, incurred beyond the reimbursement can be deductible. Now, if you don't wish the military to move you, if you choose to do it yourself, you can do what is called a personally procured move. They just changed the terminology. It used to be a do-it-yourself, or DITY. Now they just keep changing the acronyms on us here. But if you have a personally procured move, the government will traditionally say, we will figure out what it would have cost us to do it, and we'll give you 95% of that amount. So that amount is basically provided to the service person. What they have to do is submit back to the government all of their expenses and receipts from the cost of the move. If for some reason they were able to do it cheaper than the government, which is not entirely out of the question, the amount that they have incurred versus the amount reimbursed will now be considered taxable income. So that will be basically reported to them in a separate W-2. Again, any amounts that they have incurred in excess of that reimbursement can be considered a moving expense on the 3903. Again, an above-the-line deduction. So just a couple other things we want to talk about military expenses is taking a look here at what would be allowed as deductions on the return. So what we're going to take a look at are unreimbursed expenses. We may have additional expenses that the military may incur that we can take as a deduction. So unreimbursed expenses include things like uniforms. That would include the cost of the uniform. It would include any type of modification to the uniform. If you're putting amulets, if you're putting other type of recognition awards on your uniform, those are deductible expenses as unreimbursed. Cleaning and care of the uniform. Now, the trick is that the government considers any uniform allowed to be worn at any point in time not specifically related to the employment. So generally what the IRS is going to take a look at is you have to have a prohibition against wearing the uniform while not in service duty. So if you're allowed to wear kind of combat fatigues outside of your training, outside of your duty time, that is not a deductible expense. If you have a uniform that you are precluded from wearing outside of normal functions, whether it has to be either on duty or at a type of service, those are going to be deductible. So we generally take a look and see, is there a restriction on what you can purchase? So if you say that you're on guard duty, National Guard, and you bought some gloves for training, not going to be deductible unless there are specific military gloves that are not allowed to be used outside. So that's what we're taking a look at, adaptable to other general wear. Now, here's the one rule I think that may have a lot more applicability within context of VITA. So military reservists. We have a number of people that live in the area that are not active military, but they may be in the reserves. So when we take a look at travel expenses to go for military training will be deductible. So it can be considered unreimbursed employee expenses. If they're going to an area like Fort Indian Town Gap, it's a relatively close drive. It's not that far away, even though they're required to report overnight. Those would be unreimbursed employee expenses. The problem that we run into is generally for federal returns, we don't see much of a benefit. Why? Because first of all, the taxpayer has to itemize deductions. So if they're taking standard deduction, they get no benefits for any of the things we've talked about so far on this slide. They also have to get over 2% of their AGI before they get $1 benefit for unreimbursed expenses. But where does this come in? We do want to track this because we can take it for PA purposes. It can be used as a reduction of income for PA and local purposes. So travel for military training while you're in reserves is a deductible expense. Now, what do we have a benefit for? If you are traveling more than 100 miles to report for training, then those expenses for travel, lodging, are now a above-the-line deduction. They're an adjustment to income. You do not need to itemize deductions. So if you're traveling more than 100 miles to report for your training, that is now going to be an adjustment to income. So no longer is it just regular unreimbursed employee expense. So we do need to ask the question, if particularly for reservists, did you incur travel costs? So that would be mileage, it could be lodging. Typically, if they have to pay for meals, whether it's off base or if they have to pay for meals while they're on base, those can be considered expenses. So over 100 miles, adjustment to income. Under 100 miles, unreimbursed employee expense that would show up on Schedule A. Okay, a couple other things we take a look at. What are some other expenses that we may see people incurring? Any type of dues that they have. If they're professional dues, they're going to follow the same rules that we generally have as well. They have to be related to employment, which means any dues you have for an NSO club, any dues you have for an officers club, are considered social dues, not professional dues. You're not required to hang out at the NCO club after training. Maybe a nice little perk, but you're not required to do so. So those are non-deductible dues. Also, education expenses have to be related to the occupation that you're already in. So if you are a mechanic in the Air Force and you're taking accounting classes, that's not a deductible business expense. If you're a mechanic and you're taking additional classes or training on areas of jet aircraft or electronics, those are deductible expenses. So they just have to be related to the type of work that you're performing. Again, the 4491 is probably going to be our best guide for additional information. It goes through a lot of great scenarios, but we do probably want to ask, particularly because we may not see a lot of active service military here, but we do see a lot of reservists. So be sure that you're asking about expenses for travel and being sure that we can deduct those. Even if we don't get a federal benefit, we may be able to take those for state and local purposes. And given how much the reservists get paid, it doesn't take a whole lot to wipe out some of that income.